welcome to the Capital Discussions Roundtable. I'm Tom Nunnermaker with our guest, Bill Ghauri. Before we get started, Capital Discussions is not a broker-dealer or an investment advisor. This presentation is for educational purposes only. We don't know your situation and have no way of knowing what level of risk is appropriate for you. We're not making any specific trade recommendations. The risk of loss in trading options can be substantial, so please be aware of all of your risks prior to placing any trades. Hypothetical computer-simulated trades are believed to be accurately represented. However, actual profit or loss may vary due to market factors such as liquidity, slippage, and commissions. So with that disclaimer out of the way, I will turn the ball over to you, Bill. And welcome back. I think you've been on the roundtable a couple times now, so this is maybe your third or fourth appearance. So always good to have you back. Everybody really likes your presentations, and I'm happy to hear about your VIX presentation today.
Okay, well, good. Well, thanks for inviting me back. And now, can you see my screen okay, or?
Not yet. Did you share your desk?
Not yet. Let me do that. Share my screen. And I always pick the wrong monitor. Okay. Okay. Do you see it now?
Yep, we're good to go.
Okay, good. Let me put this out of the way. Move that over. Okay. All right, good. Well, again, thanks for inviting me back. And I've just put together a few slides here that I call it Stalking the VIX. And as a lot of people who may have seen some of my presentations before, they know that I really look at the VIX extremely closely, and I'm a directional options trader. So I'm looking for periods where the VIX is elevated and it's where the odds are in my favor, so that when I'm selling premium, I'm doing it at an opportune time. So in any event, I call this stacking the odds for a directional trader. So let me move on here. First, I have a little disclaimer that, of course, options trading involves risk of loss. It's not suitable for everyone. Past performance does not guarantee future results, and this is my experience, and your experience may be different. So the presentation today, I'm going to give you three concepts to think about, and then I'm going to talk about where does volatility like to hang out. And I've got a diagram that I'll show, and I'll talk about this. And then I'm going to talk about price support and resistance areas and applying technical analysis to sort of paint a picture of the market so that you can sort of stack the odds, or at least kind of know when it's a good time to be selling premium and maybe when it's a good time not to be selling premium. I'm also going to talk about patience versus trade opportunities. And then finally, I'll mention risk and money management. You've got to always include that, because that's the bedrock really of any trading plan. So here's the three concepts I'll throw out here. And one is that option premium sellers really need to pay very close attention to volatility. And this is especially true for directional options traders. And the reason is that volatility tends to revert to mean. So if you're watching volatility closely and you know that it's in an extended area, then you can expect some mean reversion. And so that's a key thing to keep in mind. And then the third one is I say, think like a sniper. You have to be patient and wait until the odds are in your favor. And if you do, then you'll often be rewarded for it. So I know that, for example, we've had the volatility has just come out tremendously over the last week or so, and it's down at very low areas. I wish I had a position on, but I'm resisting the urge to just throw something on because the odds are not exactly in my favor at this point in time. So we just have to be patient. So the one thing that's good to do is look at a volatility price histogram of the volatility index that you're interested in. as many of you know, I trade the SPX options, and so for me, I'm looking at the VIX. That's what I look at. If you're trading the RUT, then you'd be looking at the RVX, and if you were trading the NDX, then you'd be more interested in what's happening with the VIX or the VIXN, the VXN. So in any event, I look at the VIX, and what I do is I generate histograms of price distribution over some period of time. And that some period of time or look back period should be long enough to capture the ebb and flow of the market, but not too far back so that the data is irrelevant. And your histogram should also mesh with your expected DTE and DIT trading periods. And so let me just pull up a histogram here. This is one I generated a few days ago, and I'm looking at the last 90 days. And if you look at the last 90 days, you can see that it's the highest probability area is around 14. I also run this green line, which is a kernel density estimate, and just think of it as sort of like a smoothing factor. But it identifies the area where it's the highest probability area. So if you look at this and you are interested in selling premium, then obviously you want to sell when premium is higher and not lower. So this is a good sort of roadmap to say to identify areas that where you think it's a good. I mean, up here is a good place to sell, up along here, because you tend to get mean reversion for volatility. For example, today I think the VIX, it just about hit 12 today. I mean, that's just dirt cheap. So that is not a good time to be putting on a large position where you're short Vega, because if you're short Vega and you're selling premium down here, you can bet volatility mean reversion is going to come in, and that is not a very comfortable feeling to have volatility start creeping up and or rocketing up and really dinging your position. So having a histogram is, I find, an ideal provides an ideal picture for where volatility has been. Now, I mentioned about the look back period. I like 90 days because that kind of fits pretty good with the time period that I look at for putting on trades. I like to put on trades where I'm selling premium, where the DTE is somewhere between 40 and 65 days to expiration. And I'm generally in those trades for maybe about 20 days, 25, maybe 30 days, or about half the time that I'm the DTE period. So 90 days gives me a pretty good picture. I mean, there's nothing magic about 90 days. You could use, 75 days, you could use 100 days, but you wouldn't want to use, say, look back, 3 or 4 years or a longer period, because then it's sort of irrelevant. As an example, you could look back for the last 10 years, and you might find that the average volatility might be around 18 or 19, or the highest probability area. Well, in the last few months, you would have never put on a trade if you were waiting for volatility to hit 19. It's just it's not relative, not relevant to what we've had recently. So going back to the previous slide, where I say that you want it to sort of mesh with your expected trading periods, is important, and the look back period here, not too far where it's irrelevant, but then not too short that you're not really capturing the ebb and flow of the market. So this is one tool that I use that I find very helpful to kind of set a floor of the volatility that I'm looking at to sell. The other thing that I look at too a lot is support and resistance areas. And now price support and resistance can take the form of horizontal price levels, moving averages, slope trend lines. There's a lot of different ways you can define support and resistance. I tend to use the horizontal price levels, moving averages, and also sometimes I use slope trend lines as well. But these are helpful to identify some areas that are sort of points of interest in terms of where you may be putting a position on. Moving averages are very nice as well. I'll give you one that I rely on quite a bit is the 200-day simple moving average, daily moving average. That's used by a lot of institutional investors, and it's kind of I guess because it's so common, it's I don't know if it's self-fulfilling, but it's used by a lot of institutions that when you're above the 200-day moving average and it's sloping up, then you can be sort of sure that you've got a very solid long-term trend, which is up. The 20 and the 50 are good to use. But you can use really whatever works for you. But the horizontal price levels are a good thing to look at because they kind of help start to paint the picture. The other thing too that's important is that you want to monitor the chart fractal that's appropriate for your holding period. I use daily charts and I use 30-minute charts. Now the 30-minute charts I use when I'm actually getting ready to put on a trade. I like that finer detail, but a big driver is that daily chart, what I'm looking at in terms of support and resistance areas, and I of course am looking at the volatility because I'm trying to get an idea of I'm trying to paint a market picture with the tools that I have. You'll find too that price often tests and retests the support and resistance areas multiple times. So it's sometimes that can be a good time to put a trade on. Excuse me. Now I talk about the sort of painting a market picture with the tools that you have, and one thing to look at is of course, where is volatility relatively speaking? Is it high or is it low? I mean, you may want to think about how your what the vega is of your position. If it's very high, then maybe you want to have that short vega position. If it's low, then maybe you want to have a long vega position. And there's different ways you can structure spreads, and I like to use spreads when I'm looking at the money spreads, like a put debit spread, is one way to participate in having want to take advantage of very low volatility, and I want to have a long vega position. That's one way of doing it. So there's different ways you can construct positions, but as a directional trader, you need to be cognizant of where volatility is, relatively speaking. The other thing, of course, is where's the price of the underlying. You want to apply some technical analysis, use those support and resistance levels, use the moving averages. If you like some oscillators that you're comfortable with, use those. Identify, is it a solid trend up or down? Is price pulling back, or is it making new highs or new recent lows? Is it overbought, oversold? So the idea is that you're not going to be looking at any one of these things in isolation. For example, you may look at volatility and say, wow, it's really low relatively speaking. That may not be the only reason that you're going to put on say a long vega position. Or if it's high, there may be some other technical analysis that you want to apply to sort of confirm what you're seeing. So it does require taking all of the tools that you're using and that you're comfortable with and sort of painting that market picture. So and this I would say is probably a I do know a lot of option traders. They don't focus on volatility that much. They're pretty much a non-directional approach to putting on positions. It's they don't look at the volatility of the index, and they don't look at the price of the underlying in great detail. But that's the difference too between being a non-directional option trader and a directional option trader. However, I do feel that you can give yourself a significant edge if you watch volatility closely along with the price, and you'll see that these two kind of paint a picture that can give you an idea of whether or not this might be a good time to be selling some premium, or is, like today, I would say volatility was on sale. So that's kind of the idea, is to use those two and sort of paint a picture to kind of give yourself an edge. And because I do believe that being a directional trader, even if you tend to think of yourself as a non-directional trader, just having a kind of painting a picture of where volatility and price is, relatively speaking, can give you an edge, even if you're not so much. You may decide, for example, to sell some puts or put credit spreads when volatility is high, and maybe not putting on as much of a hedge. Put debit spreads, for example, as at the money, put debit spreads as a hedge right away, because as you know, you'll lose a lot of value in those as volatility comes on down and price moves up. So there's things to ways to apply these. But anyhow, I think that may be my last slide. Nope, actually I have two more. There's another thing too, that this is sort of the sniper part of the presentation, is that it's nice when everything lines up perfectly and you can say, hey, this is great. My oscillator says that I'm oversold or I'm overbought, and my moving average, prices, extended, way beyond one of, a moving average that I might look at, say, for example, like the 20 SMA, volatility has spiked up or it's down, whatever you're looking to put on, and so it's nice when all these things line up and you're thinking, hey, this is a great time to do the trade. But that doesn't always happen that way. So if you wait for the perfect setup, you'll limit the number of opportunities that you get. So you can you sort of need to find a balance between taking too few what I'd call high quality trades and too many poor quality trades. And so one way to do this is to participate in more trading opportunities, is to vary your position size based on the quality of the potential trade. So while not everything may line up just the way you'd like to see it, there might be enough things there in terms of, say, enough elevation in the volatility. Maybe it's not quite to the level that you'd like to see. There's some bit of a pullback in price, and maybe your oscillator is saying, okay, yeah, we could be here in an oversold situation. Maybe I'll go ahead and put on, sell some puts. And but one way to do that is, rather than going in with your full allocation, is you could go in with a partial size, and that way you're kind of limiting the risk, because you don't want to. I would say you don't want to treat every single trade opportunity the same, because they're not. They do differ in terms of quality, and that, I guess, is just something that you just the more experience you get in terms of applying technical analysis, that you'll start to recognize that some opportunities are better than others. As I have said before, not all trade opportunities are created equal. So there is a way to participate in more trading opportunities by limiting the size on those opportunities that may not be quite as good as you'd like. And then finally, you do have to apply your risk and money management to the trades you do. I use a fractional risk of 2% of my allocated capital, which is a fairly reasonable number. You can use a little more, you can use a little less, but that's kind of the maximum that I like to do roughly on a trade. And then you do calculate the number of, for me, since I trade naked SPX puts, I calculate the number of contracts, and you could do it for spreads as well, based on the fractional risk and the trade price risk. And the trade price risk is based on your entry price and where you're setting your stop. I've done some other presentations on this, which I believe are available on the general capital discussion website, where I go into this a bit more detail. But you definitely can't throw out your risk and money management. It all works together. And so when you do sort of stick to your plan, then it keeps you out of trouble. So I think that's it. People can give me any comments or questions here. I'll leave it at that. Let me change this screen. So Tom,
yeah, I don't think questions yet.
Okay.
Maybe
if you have any questions as well.
Talk about how you've your trades with your service have been going, and how the VIX plays into those. Maybe you can just look over, how you've made decisions with the VIX and the recent trades you've done.
Sure. The ones that I don't have a July position on at the moment. I've been kind of waiting for a period of a VIX pop, but haven't gotten that, and it's kind of frustrating to not have a position on when you see the volatility just crawling lower and lower, because the type of positions that I like to do, primarily when you're in a solid uptrending market, as we've been in for so long now, you make your money from selling the puts or the put credit spreads. Everything else is really sort of secondary. The money comes from selling puts and put credit spreads. You can try to sell calls or call credit spreads in an uptrending market, but you're really going against the grain. And so in all of my testing, back testing that I've done, I've found that I won't say it's a losing proposition, but it's certainly not the money maker. You're not going to be making a lot of selling calls, particularly if you are not being directional in your decisions, in terms of taking into account the underlying and the where volatility is. So it really all does come down to the puts and the put credit spreads, and that's where the money comes from. So just as here recently, I haven't had anything on the last positions I took off, so that's kind of that's my thoughts on that. I'll also mention too, this is something that I don't have a slide on this, but I can sort of describe something here that as a non-directional trader versus a directional trader trading the same type of position. And I'll give an example. I used to trade broken wing condors. That was my mainstay. That's really kind of a weirdo without the call credit spreads. And so what I would do is I would wait until volatility had a pop, because I knew that I made more money if I was patient and looked for that volatility pop, and then I'd put on I'd sell my put credit spreads. But then I would also shortly after, and sometimes not wait too long, I'd put on my at the money put debit spread hedge, and I would usually put them in quantities such that the roof, so to speak, of the position would be between 2.5 and 3 times that of the hood part of the position, to use Jim's and terminology. And but what I found is that over time that I was losing on the put debit spreads quite a bit, and and over the looking at the course of going back several years of doing this, I realized that, you know, I'm hitting it right. I'm doing one part of this trade correct, and that is waiting for the volatility pop to sell my put credit spreads. But the bad part is that putting on the hedge at the same time, I was losing a lot on that. And so I was limiting how much I was making because they would always be losing. And if you look at a typical you know, broken wing condor position that's put on all at the same time, it's almost as if you wait until that real volatility pop, yeah, you'll make money on the put credit spreads, but you'll lose. You'll pay a lot for that hedge. It'll decay quite a bit. And then if you're going out and buying some longs, in addition to that, when you're having that volatility pop, those things will lose value faster than anything because as a lot of option traders know, that the decay profiles, the theta decay profiles are different between at the money or near the money options versus those that are far out of the money. Because if they're far out of the money, then they decay quite a bit very fast. And that's a very typical strategy, is that to put on a broken wing condor and buy some teenies or whatever you want to call them way out. But if you're doing that, because at the time of a volatility pop, you're paying dearly for those because first off, you're paying a high price for those out of the money puts, far out of the money puts, because volatility is in an elevated area, you know, elevated point in time. So that's one. Then the second is the volatility skew, because volatility skew, of course, most people know, option traders know, that the volatility, as you get further out of the money, that volatility skew, I mean, it goes up. So it's then when you get that volatility, when it starts to come out, those things lose a lot of money really fast, and that dings your P&L. So now I know that the reason why non-directional option traders do that is because that's a method of risk management, is that you buy some teenies far out of the money, you hedge it with an at the money put debit spread, and that's sort of, you know, the way of putting on a position, because you're putting it in with a non-directional frame of mind, saying, I don't know which way the market is going. I don't know if volatility is high or low. I don't know if price is going up or down, but I'm going to put on this position, and I'm going to put it on as if I'm loaded for bear here, and that's just the way that strategy works. I find that it's much better to be patient, watch the VIX, know where volatility is relatively high and relatively low, and then put on your position of selling your puts or your put credit spreads. Now, if it does go against you, keep in mind that you've put on the position at a statistically advantageous point in time. So if it goes against you and you have to roll it, it's further putting you in a statistically advantageous point. So I find that actually is a cheaper way to manage these positions, by being proactive in terms of if it does go against you, but being or placing yourself in a statistically advantageous position to begin with, and you can end up making much more in a shorter period of time with, I think, a very controlled amount of risk. So that's kind of the way I approach selling premium.
Hey, Bill, do you think if you have option view or option net, if you could maybe just walk through an example of selling time when the volatility pops and it keeps moving?
Sure, yeah. Let me get this here. I can close that out. Let me see where I got. Let me do some stuff here. I got some things going on here. Yeah, I'll let me get rid of some drawings here to sort of, because this is actually a how I often look at the daily chart, and I'll use the daily chart as an example. The first off, everyone see the screen okay?
Yeah, it looks fine.
Okay, so so what a lot of I know that the subscribers know how I set up my chart because I've done this, mentioned this in the updates. But what I do is on my daily chart, I use a 20-day moving, 20-day simple moving average, which is this yellow line. I use a 50-day moving average, which is this sort of turquoise blue line, and then I use a 200-day simple moving average, which is this green dotted line. I use volume, and then I use the RSI2, which is a pretty fast setting, and then I have an over bought area of 90 and an oversold area of 10, and so that's something that I use to look at. It's not the only thing I look at, but it's one thing that I look at. So what I like to do is I like to identify areas of support and resistance. Like, for example, you can see here that we've had this resistance area around 2118 going back to February. So I mean, it tried to get through it here a couple of times. It made some attempts, and then we kind of got through it. We came up, and we've sort of come back and tested it here. We actually did test it in the pre-market. Of course, you can't trade in the pre-market, but it came down and tested it. So clearly, we're sort of coming up through this resistance. Now, what I like to do is I like to sell premium when, first off, there's two things need to happen. One is that I need to see a spike in the VIX. And if I look at the VIX, now this is a daily chart of the VIX, just with the same, I actually don't use, let me do that. I don't use any indicators when I'm looking at the VIX, but a good indication to me that it's a good time to sell some premium is that if you've had a nice spike up over the previous day, and you can easily see that on your platform, whatever platform you're using, that like, for example, today, the VIX is down almost 6% from the previous day, and you can see that right here. I mean, we're down in some very, very low areas. If you recall, looking at that histogram, I mean, the highest probability area right now is around 14, given the last 90 days. I've been running a floor of around 15, but you know, I mean, I'll consider selling some premium if it hits up around 14. Now, and this is the point about sort of using all of your tools together. Don't look at any one thing in isolation. So for example, if we go back and look at the ES, which is what I look at, while I trade the SPX, I look at the ES. I look at the futures market because it gives me volume. And I make notations of what's going on with the volume. But if you're looking at the, and let me bring back the studies here. If you were looking at the ES and you were looking at, say, for example, your oscillator, and it came up here above 90, and you're thinking, oh, okay, we're at a pretty solid overbought area. Maybe I want to get short Vega. Well, perhaps, but take a look at your VIX. What is where is the VIX? Perhaps it is, perhaps it's not. The wonderful thing about looking at both the underlying and the volatility index is because you can take advantage of the inverse correlation between the two. I mean, generally speaking, there's an inverse correlation. As the price goes up, volatility goes down, and vice versa. So it's a nice thing to sort of confirm what you're looking at to get a picture. Now, the other thing too is here's a very simple thing to look at, and that's the 20-day moving average. I find that price only gets up so far above it before it kind of gets sucked back down to that 20 SMA. So it just shows you price doesn't keep going up forever, and it also just doesn't keep going down forever. It's always that battle between buyers and sellers that always sort of make it make price do it in a stair-step fashion. So so there's different things that you can use, but just and these are just things that I use. I mean, I know people use a lot of different, they use MACDs and stochastics and, exponential moving averages and things like that. And that's all fine. It's just a matter of finding a set of tools that work for you, that you're comfortable with, you feel like you can read them reasonably well, you can identify some overbought, oversold areas, and then you apply it. Now, for example, I did take some trades here, and just going back, I don't recall, I think it was, I took a trade here when price came down. This was a volatility spike on this day. I ended up, I think, taking another trade around here. I took another trade. I think this is, anyhow, but it's the times when you see a good solid pullback, that will coincide with a nice pop in the VIX. And just watch your VIX. I mean, you're up, 7, 8, 9, 10% over the previous day. Maybe that's a time to be looking at selling some premium. In a case here where we're down around 12, I mean, my gosh, this might be a good time to put on a long Vega position. I mean, this is low. I mean, this is what I call volatility on sale. That's pretty darn low. Almost to the point to where I'd almost start buying some at-the-money puts, but not doing that yet. But anyhow, and then just taking essentially a directional a delta bet. But this is low. This is very low. So that's, I guess, just a sort of a chart tour of what I said earlier.
I remember you had a trade that sold some puts and it moved against you and hit your stop, and then you rolled it. And it's interesting because with the volatility skew, when you roll those, you're buying a lower volatility than you're selling on the roll. So it actually is not as expensive as you might think it is. So I don't know if you can show that. That's real.
Yeah, I have those charts. I'd have to find them here. Let me see if I have them actually. No, let's see. Let's see. Was this the one here? Okay, maybe this is it. Okay, can you see that one? Okay.
Yeah.
Okay, so this was a trade that I did. I sold the June 1975 put for $14 at this point here, and I set a roll multiple at 1.2, which was at 16.8, and so what happened was that I didn't hit it that good because price kept going, and it went actually through my roll price. So when I actually executed it, I got executed about 1715 rather than 1680. So I had a little bit of slippage there. But this trade ended up still working out. And let me see, I think 1975.
I think you could actually your class trade performance, and that would show that trade and how you're taking small losses, but then when the trades work out, then you end up with a really good mathematical expectancy.
Yes, it does work out. Was this the one? Okay. I should have queued up these charts beforehand so that I could have shown it. So I don't remember exactly which one was which, but here's just one I'll as an example is that I sold the June 1950 SPX put. I sold it for $13, had a stop multiple of 1.2, which was up here around 1560. So the price risk here was $2.60. Now I actually exited down here at 570, and this was a very short trade here, because you can see I was only in the trade for 3 days, but we made $7.30 on profit. So our risk reward ratio on this was 2.8 to 1. And so this one worked out, nicely, in a fairly short period of time. One thing that I do, and the subscribers know because they've seen the charts that I put up, that I typically look at these types of charts of the option itself, a price chart. I just do a 30-minute chart. Don't need anything fancy. You don't need any indicators or anything like that. But I just make a note of where I got in when I sold it, where I would roll it. And to your point, Tom, the nice thing about rolling is especially when you're doing nakeds, is that, well, there's two things that's nice about when you're doing these as naked puts, is that one, you roll this with a vertical, and you do it by, let's say, for example, this is a 1950 put, and let's say it hit up here at my roll price. At that point in time, what I'd be doing is buying the 1950, and then I would be selling one that's further out of the money. Maybe it's maybe 25 points further out of the money. Maybe it's 20 points. It just depends. But you do that as a vertical, and so the further out of the money put has a higher volatility because of the volatility skew. So it actually puts you in a nice position where, yes, you're having to buy the original one that you sold at a loss, but the one that you're selling actually has a little more juice because of the volatility skew. And but these are the type of charts that I typically look at when I have a trade on. So that's kind of.
I put a link in the chat for you. That's actually your class page with the trade performance, so people can actually see how your trades are, how that works out in real life.
Okay.
A few small losses here, but when the trade matures, it takes a nice profit.
Yeah, because the thing that actually I did let me see if I can pull up a chart here that. Move that out of the way.
If you click on that link in the chat that I put for you, you should pull it up.
Okay. Let me. Okay, it brought me my. Let's see here.
Yeah, and I just did it to Bill because it's actually his paid subscription class page.
Okay, was this what you're referring to here?
Yeah, actually, if you go to classes and then if you click on. Okay.
Okay.
If you go to classes and then if you click on. Okay. If you go to classes and then if you click on. Okay. If you go to classes and then if you click on. Okay. If you go to classes and then if you click on. Okay. If you go to classes and then if you click on. Okay. If you go to classes and then if you click on. Okay. If you go to classes and then if you click on. Okay. If you go to classes and then if you click on. Okay. If you go to classes and then if you click on. Okay. If you go to classes and then if you click on. Okay. If you go to classes and then if you click on. Okay. If you go to classes and then if you click on. Okay. If you go to classes and then if you click on. Okay. If you go to classes and then if you click on. Okay. If you go to classes and then if you click on. Okay. If you go to classes and then if you click on. Okay. If you go to classes and then if you click on. Okay. If you go to classes and then if you click on. Okay. If you go to classes and then if you click on. Okay. If you go to classes and then if you cli Not, yeah, go to the class. Yep. And then the trade performance or trade history.
Okay, yeah. So yeah, these are the trades that I did. You can see that here, I mean, where you make the money is on the short puts. And now I do trade one account, which is a Reg T account, and those are spreads. But for the PM account, it's the short puts that you make the money. And like some of these you see, like for example, this one here, we took a small loss, sold the June 1975, and then ended up having to roll that. I actually had to roll it on the same day. Took a small loss, but the trade that we were in ended up making some money, so that covered our loss. The first one we did here, that was that June 1950 put trade, so that one did well. I did some calls, and as I was mentioning, with calls, it's tough to make money in a solid uptrending market selling calls. So I do a very limited number. This one was actually a roll, but it ended up making a little bit of money after the roll. So did actually make money on the calls there. So it's, and then this one here, I guess the more recent one here, I did put a hedge. Now, it wasn't the same day that I sold the puts. It was the second day, but I took that off, and that one was a 2-day trade, and it did okay. So so yeah, you do have a few losses, but this is again, the whole philosophy is that you're starting out a trade where you're stacking the odds in your favor to begin with. And what I mean by that is you're looking at the volatility. You are pretty I'm not going to say you're guaranteed mean reversion, because I hate to use that word, but volatility does tend to revert to mean, and so it's something that you can use to your advantage. But you do definitely have to be diligent in terms of rolling the positions and making sure that you don't let them get out of hand. But well, anyhow, so you know.
Question from the attendees about what about selling ES futures options instead of SPX? Better margins.
You know, I like to stick with the SPX because of the liquidity. I mean, liquidity is just key. I mean, if I tell you what, I'll just pull up just so that, I mean, some of the people may have seen the tool that I use called SAM, and if I just generate a model, for example, of puts, and I get some options here. Take a look at the open interest here of the SPX, and it's you have some great liquidity, especially when you're looking at the strikes on the the 25 increment strikes. I mean, some great liquidity here. 38,000, 21,000, 14,000, 22,000. Now the reason why, look at this, 35,000, 55,000. The reason this is important is because when you go to execute, you want high liquidity, because then the bid-ask spreads tend to be narrower, and so you're more likely to get a good fill. So it's real important. Now, look at this kind of liquidity, and now if we were to say look at say in the NDX for the same here, and look at the open interest here. I mean, this is pathetic.
Quite a difference.
I don't want to say pathetic, but I mean, my gosh, this is next to nothing. And then even compare it to, say, the rut, same expiration. We'll do puts. And yeah, it's better than the NDX, but come on, and see, I'm not looking at like 5-point increments, because I don't even look at those. The way my model works is I'm looking at either 10-point or 25-point increments, and so this is why I like to use the SPX, is because of that liquidity.
And Bill, real quick, there was a question, how do you force a RTD update? It looks like you just click the Get Options button up at the top.
Oh, okay, yeah, using TOS tools or SAM, how do you force an R? Okay, it's once you create the table, the RTD links are live. As long as your Thinkorswim platform is operating, it will be live. So there's nothing you have to do to force an update.
Is there anything you have to do? It's broken and you need to reestablish it? Maybe just close it and reopen?
Well, here's the thing: is that it's for example, it's so easy to generate these models that the best thing to do, in my opinion, is when you want to generate a model, then you just do it. Like, for example, during market hours, you want to do an analysis of some credit spreads or debit spreads, which, by the way, I did add a new feature to this, that you can now analyze debit spreads or credit spreads. So, for example, if you wanted to analyze debit spreads, we have very low volatility now, so maybe we might be looking at doing some debit spreads. So when you do debit spreads, what that does is it creates a table of all of the potential debit spreads. And if we look at this, I mean, we're looking at, holy cow, 667 potential trades. Now, obviously, we're not going to be interested in all those, so we add some filter parameters, and I set it up with some defaults. And so if we apply the filter, now we get that 600 potential spreads down to a more manageable number. And so these are some potential debit spreads that we might be looking at. Now we can apply the linear regression analysis, and then we can chart it to kind of get an idea of, how these spreads compare, relatively speaking, to a linear regression line. And so, for example, if you're looking at this, the way I like to use this is that it sorts it by distance from the linear regression line. And of course, when you're buying a put debit spread, you want to make sure that the long is as close to the money as possible. And so, in other words, you want it to have the delta as close to a minus 0.5 as you can get. Whereas in the case of a put credit spread, you want to get something that's the furthest away. Now, the nice thing about looking at spreads in this way is that the markets are not 100% efficient at all times. If they were, all these spreads would be perfectly lined up. You can really see it in the terms of credit spreads, in my opinion, when the volatility really starts getting up there, because then you really start to see some variation, and it's that variation that we can use to our advantage. But just looking at some debit spreads here that you might potentially want to sell, for example, here's some 21.25s, which are at the money. And here's the price of the spread. So, depending on, several of these could look pretty good. Here, the 21.25, 21.25, 2100, that's a pretty well-priced spread. But would you want to do something up here? Maybe not, because that's, relatively speaking, it's not as good a value, because when you're buying a debit spread, you want to buy one that's cheap. When you're selling a credit spread, you want to sell one that's expensive. So the distance between that linear regression line is, in a way, how you can sort of determine whether something is cheap, which is on this side of the line, or something that's expensive, which is on this side of the line. Now, of course, it's not I mean, it's just, it can be a small edge sometimes. Sometimes it's a greater edge. It just all depends on what the market's doing. But it's a tool that allows you to say, hey, you know, some of these here, like if you were, now these are, I've generated this as put debit spreads, but you might be looking at something that's a credit spread, and you, well, here, let's just do that. Let me just clear this out. Actually, so this is puts. So now I'm going to do credit spreads. So I'll apply a filter, and we'll look at something with a delta of 20 or less. Okay, so we apply the filter, do a little linear regression, and so here we go. So now, if we were looking at selling some spreads, now we wouldn't be doing this because the volatility is so low, so now is not the time to be selling credit spreads. But if we were, and we might be looking at some of these spreads along here rather than some of these along here, because the vertical axis is price, the horizontal axis is spread risk based on the formula. And for those that are listening that have not seen my presentations on how I calculate the risk, they can go back and look at those. Those are available on the general library. But you can start analyzing what spreads might be relatively overpriced, so to speak. And if you're selling something, you want to sell something that's, you know, high price. And so that's how you do that. So, and then you have, of course, all kinds of flexibility in terms of, you know, how you want to filter it, because you can change any of the filter parameters that you want and get it narrowed down. But what it does is it generates, like, for example, this one here, again, 600 and some odd potential spreads. And the nice thing about this is that you can whittle it down to the spreads that you're interested in very quickly. And of course, to do this manually, you couldn't do it. So the tool is kind of handy for that.
Hey, Bill, we're kind of running out of time, but a couple quick questions. Just to make sure, Tim said, does this come with as part of your service? And I said yes, because I'm pretty sure it does.
Yes, it does, as well as the TOS Tools program, which is another program that people can use to generate. I can do a quick demo of that if you want to see just very quickly. I did a TOS Tools here. So what this does allows you to generate trade logs and open position reports. And I do believe I have some stuff here that from an earlier presentation. I think this is it. But what it does is it takes the CSV file from your thinkorswim, and then it allows you to narrow down and figure out what you've made in terms of, like, for example, I'll show you here for June. This is our June positions here, and this is in the PM account, and it does all of the calculations, all of the formatting, and it even puts in RTD links for your mark price so that you can analyze your current position if you have some open positions. So for June, it's all closed out, so there's nothing open. But here's an example of how you can do some post-trade analysis to say, how much did I make selling puts? How much did I make selling calls? And then you can calculate your P&L and how many days you were in the position. So this is another tool. You can also do the open positions, which does something similar. it calculates the Greeks and some key ratios for your open position. So these two tools are available for subscribers, and I may be coming out with some additional tools. It just kind of depends on time and need, and so if anyone has any suggestions on tools they'd like to see or modifications, just let me know, because anything that I can do to help traders with the accounting and record keeping and analysis and tracking and whatnot, it's a good thing. So.
Great. One last question is, how do you determine your stop loss? Is it always the same percentage?
I use a stop multiple, and I typically use a stop multiple of around 1.2, and that's based on back testing that I've done, looking at doing a 10-year back test in the SPY, and I found that there's a balance between where you set your stop multiple and how much you're putting at risk, and also the technical analysis behind when you're getting into the trade. So in my back testing that I did, I used some technical analysis to basically calculate opportune times to be selling puts, and then I applied the risk and money management, and I just sort of came up with a set of rules, which are I've talked about this in some previous ones, but I mean it's pretty. For example, in selling puts, I've got some rules about selling at 40 to 65 days to expiration. I found that that's a nice sweet spot. I like to sell with deltas, with the short puts with deltas of around 20 or less. I look for those elevated volatility levels. I look at the histogram. I look at I do the technical analysis, all the stuff that I talked about in today's presentation. And using a stop multiple of about 1.2 works pretty good. There's also a whole thing about risk reward ratios that I try to achieve. I like to get around a 2.5 to 1 if I can, or better. But I've also done some presentation on that, and so people can go back and look at the library of some of those presentations and get a better understanding of how it all kind of comes together, because it's really a holistic plan. I mean, you got to have a risk and money management plan. You got to have a plan in terms of how you're applying your technical analysis of knowing when you're getting into trade. What are you going to do when it goes against you? I mean, you just have to have a plan, and it's just you hear all the time, have a plan and trade the plan, and so that's basically what I do.
Well, and Bonan had a comment. Great job, Bill, as always. So
thank you.
Really appreciate it.
Okay, well, good deal. Again, if anyone has any questions, feel free to email me. I can usually get to emails pretty quickly, since I'm sitting at my computer pretty much every trading day. And also, if you have any ideas or comments or suggestions on tools that might be of help, float them by me, and we'll see if it's something that we can put together.
All right. Well, thanks everyone for sticking with us, and I really appreciate you, Bill, and awesome presentation as always.
Okay. Well, great. Thanks. Well, everyone have a great day.
Thanks, everyone.
All right. Thanks, Tom.
Bye.